George Soros is mainly a short-term macro speculator. His trading approach centered around making highly leveraged, one-way bets on the movements of currency rates, commodity prices, stocks, bonds, derivatives, and other assets based on macroeconomic and market analysis. He applied scientific inquiry in his investment strategy, merging it with his belief in free markets and human rights. The 5 key trading rules and elements of his investment approach are: the reflexivity theory. The theory opines that the market participants themselves directly influence market fundamentals and that their irrational behavior leads to booms and busts that present investment opportunities. Soros uses reflexivity as the cornerstone of his investment strategy. He looks out for market bubbles and booms. Scientific method. Soros uses scientific methods to study the market. He uses current market data and probability to formulate a strategy that tracks what will transpire in the financial markets. He usually tests his theory with a smaller investment first, and increases his investment if the theory proves positive. Physical cues. He also listens to his body when making investment decisions. For example, a headache or a backache could be enough for him to abandon an investment. Blending political acumen with investment acumen. Soros combines his knowledge of politics with his market analysis. For example, he once bet heavily against the UK government's decision to hike interest rates in September 1992. That trade forced the BOE to devalue the British pound, sending stocks higher after that devaluation. Soros made about $1 billion from that trade and earned the famous moniker, the man who broke the Bank of England. Read and reflect. Soros has a handful of advisors/analysts he confers with when he wants to make big investment decisions. According to him, after discussing with his team of analysts, and making sure to review at least one contrary view to his strategy, he takes time to read and reflect before pulling the trigger. George Soros is a maverick. According to him, instinct plays a large role in his investment decisions. However, he is well informed about economic and political trends on a regional and global level, and he uses that knowledge to exploit market inefficiencies, making large, highly leveraged bets anywhere he sees an opportunity. Interestingly, he has both the capital and the risk tolerance to ride out these bets for longer than most hedge fund managers can. Soros bases his trading principles on his theory of market reflexivity. According to him, market sentiment has a self-reinforcing effect, positive feedback, such that rising prices attract more buyers whose actions drive prices higher still until the process becomes unsustainable, and the bubble bursts. The market comes crashing. On the other hand, falling prices induce more people to sell, driving prices further down, until the prices become very attractive to investors, and a buying frenzy starts, giving rise to a new bullish trend. While Soros uses his reflexivity principle to study the markets and has deep knowledge of global markets and excellent sources of information, knowing the exact moment to close out a trade is more of a gut feeling than a market signal. He has mastered the markets so much that he instinctively knows when the time has come to close out for a profit long before he can rationalize the decision. Soros's hedge funds are well known for using the global macro strategy, an investment approach that is centered around making massive, one-way bets on different financial assets, such as currency rates, commodity prices, stocks, bonds, and derivatives based on macroeconomic analysis. Generally, the macroeconomic analysis focuses on 3 things: national output, measured by gross domestic product, unemployment, and inflation. Thus, global macro funds, such as Soros's, build portfolios around predictions of large-scale shifts in GDP, unemployment rates, inflation, interest rates, currency exchange rates, political changes, and policy changes across nations, continents, and the world as a whole. The global macro strategy allows funds to place any type of trade on almost any type of security in any country of choice.